Hey everyone! If you've ever placed a stock market trade, you're likely getting ripped off and paying more than you should have without even realizing it. Today, we'll see how to save money and avoid being cheated when placing trades. Before we get started, a quick disclaimer: this is not investment advice. Every case is different, and we are not licensed financial professionals. High-frequency trading is a super fast automated form of trading where powerful computers execute thousands of trades in milliseconds. These algorithms analyze market data, spot tiny price differences, and exploit them faster than you can blink. They can buy and sell stocks in fractions of a second, capturing minuscule profits that add up to billions over time. When you place an order, high-frequency trading algorithms can detect it and react before your trade is fully executed. For example, if you try to buy a stock, they might buy it first, drive up the price, and then sell it back to you at a higher cost. This is called front-running, and it's one way your trades can get exploited. Another tactic is spoofing, where high-frequency traders place large fake buy or sell orders they never intend to execute. These orders create a false sense of supply or demand, tricking the market into moving the price in a favorable direction. This can lead to you buying or selling at a less favorable price than you intended. So, what can you do to protect yourself? First, consider using limit orders instead of market orders. This ensures you only buy or sell at a specific price, preventing high-frequency trading firms from exploiting bid-ask spreads. Second, be aware of the market conditions. Avoid trading during highly volatile periods when high-frequency trading activity is at its peak. By understanding these tactics and making smarter trading decisions, you can minimize unnecessary costs and avoid getting the shorthand of the stick.